3 years ago, you probably heard a sentence that sounded almost unbelievable. You can own a multi-million home while paying only around $20,000 a month. Back then, it didn't sound like marketing hype. It felt like a once-in-a-generation opportunity, a golden ticket, almost like the government itself was handing young families the key to financial freedom. People who never thought homeownership was possible suddenly saw a door opening. Couples in their late 20s, newly married families, young professionals tired of paying rent, all of them rushed in at the same time. Buying a home suddenly felt cheaper than renting. But fast forward to today, and if you ask the first wave of buyers who jumped into those new development zones, places like Qingpu in Taiyuan, Quoto in Kaohsiung, or new expansion areas around southern tech corridors, their expressions look very different now. Back then, they were lining up overnight just to secure a unit. Today, many of them are quietly staring at their bank accounts, watching something far more terrifying than rising prices. Because behind that easy payment promise was a burden most middle-class families were never prepared to carry. And now reality has arrived. The grace period is over. The mortgage honeymoon that everyone relied on has officially expired. A few years ago, buyers were offered extremely attractive mortgage terms. Long repayment periods, generous grace periods where borrowers only needed to pay interest, and loan limits high enough to make expensive properties suddenly feel affordable. Many buyers chose shorter grace periods, 2 or 3 years, thinking they could refinance later or simply sell the property at a profit before higher payments kicked in. The assumption was simple. Prices would keep rising, banks would keep lending, and refinancing would always be an option. But today, interest rates sit much higher than they were back then. Banks are now hitting regulatory lending limits. Mortgage quotas are tight, and refinancing options that once seemed guaranteed have practically vanished. This month alone, thousands of homeowners across the island opened their banking apps and saw their mortgage deductions jump overnight. Payments that used to be around $20,000 suddenly doubled or even tripled, jumping to $60,000 or more in some cases. And this isn't just a higher bill. For many families, this feels like financial suffocation. Savings disappear instantly. Disposable income vanishes. Life plans collapse. And here's the dangerous part. If you still believe property prices will keep rising forever, and you're thinking now might be a good time to jump in and buy the dip, then you might be walking straight into someone else's financial disaster. Because right now, buying at the wrong time doesn't mean investing. It means catching the falling blade thrown away by speculators who bought at the top and can't hold on anymore. In today's video, we're not going to rely on rumors or empty predictions. We're going to walk through the logic, the numbers, and the market mechanics behind why this housing miracle is unraveling and why certain regions are now facing the first real wave of forced selling. If you don't understand what's happening, the next group caught in this cycle could be people like you. Hardworking buyers stepping in just when others are trying to escape. And if this kind of deep market analysis helps you see things more clearly, make sure you follow the channel and share this discussion with friends or family members who are thinking about buying property right now. Because understanding timing might save someone from making the biggest financial mistake of their life. To understand why distress selling is starting to appear, we need to go back to the policy that ignited the buying frenzy in the first place. The program was originally designed with good intentions to reduce housing pressure on younger generations. But the conditions were so attractive that they didn't just help buyers. They pulled huge numbers of people into the market all at once. High loan limits, extremely long repayment periods, multi-year grace periods where borrowers only paid interest. To a struggling property market at the time, this was like injecting adrenaline straight into the heart. Suddenly, people who previously couldn't afford homes felt they finally could, and demand surged almost overnight. But hidden beneath that opportunity were several financial traps that most buyers didn't fully understand. And the first trap is what we call payment shock after the grace period ends. Many borrowers misunderstood what the grace period actually meant. They thought it was government assistance making payments easier. In reality, it was simply delaying the heavy burden. Let's walk through a simple example. Imagine you borrowed $10 million at around today's effective interest rate, roughly in the low 2% range after subsidies ended. During the grace period, you're only paying interest. Monthly payments stay below $20,000. For a dual income couple, that feels manageable, sometimes even cheaper than renting in major cities. But once the grace period expires, principal payments begin, and suddenly, monthly payments jump to over $33,000 or even higher, depending on loan terms and credit conditions. If the loan period was shorter, or if interest rates increased further, payments could nearly double compared to the grace period. And that's where many families suddenly realized their budgets no longer worked. Because salaries didn't double, living expenses didn't shrink, but mortgage payments did explode. And that shock is only the beginning of the problem. And this leads us directly into the second trap, the refinancing escape route that suddenly disappeared. Back when everyone was buying, nearly every real estate agent, online influencer, and investment seminar repeated the same comforting advice. Don't worry about the grace period ending. When the time comes, just refinance with another bank and reset the clock. It sounded easy, logical, almost guaranteed. But today, that promise has become one of the biggest illusions in the market. Banks are no longer competing aggressively for mortgage customers. Instead, they're tightening lending standards. Regulatory limits now restrict how much exposure banks can have in real estate loans, and many institutions have already reached those ceilings. So now, when borrowers walk into banks hoping to refinance, they hear something completely different. Not, "Welcome," but "We're sorry, there's no room." In many cases, even the original lending bank becomes cautious, asking borrowers to maintain stricter financial ratios or rejecting requests to restructure loans. This creates a dangerous situation. Investors who plan to refinance are suddenly stuck. Their payments double, but their options disappear. And financial pressure doesn't just exist on spreadsheets. It attacks people psychologically. Sleepless nights, constant anxiety, arguments at home, fear every time the bank message appears. Some owners start burning through savings just to keep up appearances. Others borrow from friends or use personal loans to survive another few months. But eventually, reality catches up, which brings us to the third trap, the interest rate environment. Just a few years ago, ultra-low mortgage rates felt normal. Rates under 2% became the standard expectation. But we're no longer living in that world. Global inflation pressures forced central banks to raise rates, and cheap money disappeared. For homeowners who stretch themselves to buy property using maximum leverage, every rate increase feels like another weight added to an already sinking boat. And when multiple pressures hit at the same time, the market becomes brutal. First problem, owners can't sell easily. Because of tax rules designed to discourage short-term speculation, selling within certain time frames triggers heavy taxes. Once transaction costs, renovation expenses, and accumulated interest are added, many sellers would end up losing money if they sell now. Second problem, renting doesn't save them either. In many new development areas, huge numbers of properties are being completed simultaneously. Entire neighborhoods are receiving keys at the same time. And when supply floods the rental market, rents stagnate or even drop. Monthly rental income often doesn't even cover the mortgage payment after the grace period ends. So owners face a painful equation. They can't sell without losses. They can't rent for enough income. And they can't afford rising payments forever. Eventually, something breaks. And that's why what we're starting to see isn't just a small price adjustment. It's the early stage of forced selling, what many call the beginning of a distress wave. If this situation feels familiar or uncomfortable, keep watching carefully. Because later, we'll explain how to identify properties most likely to face price collapses so you don't become the next buyer stuck in the cycle. Right now, before we go deeper, take a second to like and share this video so more people understand the risks before making irreversible decisions. Now we arrive at the core of the discussion, the areas most vulnerable to price pressure. For prices to fall sharply, it's not enough for some owners to struggle with payments. There must also be chaos in ownership structure. In simple terms, neighborhoods filled with investors, not residents, are the first to crack. When most owners never intended to live there, loyalty to the property disappears. Once profits vanish, selling becomes the only goal. Based on recent transaction data and internal lending patterns, several regions are showing early warning signs. The first vulnerable group includes areas benefiting from tech industry expansion in southern regions. Over the past few years, expectations around technology parks and industrial growth drove huge price increases in surrounding districts. Young buyers feared being permanently priced out and rushed to purchase, often using maximum loan limits combined with personal loans just to secure properties. Prices climbed rapidly, sometimes reaching levels disconnected from local income reality. But here's the problem. A large percentage of those buyers were not local residents. Many were investors planning to flip units quickly during the grace period. Now, heavy transaction taxes and tighter lending rules trap them in place. They can't exit easily. Another issue is rental yield deterioration. A typical two-bedroom unit in those regions might rent for just over $20,000 per month. But after grace periods expire, mortgage payments often rise to $35,000 or $40,000 monthly. That means owners must personally cover the difference every single month. For young professionals or small investors, bleeding cash continuously is unsustainable. And when owners realize renting won't save them and selling means losses, some eventually choose forced liquidation just to protect their credit. But this is only the first domino, because the next region under pressure might be even more fragile. The second major pressure zone sits further north, in rapidly developed suburban districts where prices didn't just rise. They surged beyond what local demand could realistically support. These locations once became favorites for first-time buyers because total property prices conveniently fit within attractive loan limits. On paper, everything looked perfect. Modern buildings, large master-planned communities, easy marketing slogans promising future transportation upgrades, business growth, and rising values. But today, those same neighborhoods are turning into financial pressure cookers. And the reason comes down to a brutal market psychology known as seller against seller competition. Walk into these communities and you'll see enormous residential clusters, dozens of identical towers, each holding hundreds of units. Thousands of apartments completed around the same time. At first, everyone feels secure. Prices rise. Owners feel wealthier. But when grace periods end and mortgage payments double, even a small number of stressed owners can trigger a chain reaction. Imagine just 5 homeowners in a massive community suddenly needing to sell quickly to avoid default. They don't compete against the market. They compete against each other. Each seller lowers the price slightly to attract buyers faster. Then the next seller cuts even more. And once the first discounted transaction appears in official records, the entire community's valuation resets lower. Banks immediately adjust their appraisals downward. Now new buyers cannot borrow enough to meet previous asking prices. Sellers must cut prices further to close deals. Lower prices lead to lower appraisals, which lead to even weaker buyer offers. A vicious downward cycle begins. And remember, many owners in these areas stretched their finances to the maximum just to enter the market. They expected to refinance later, extending grace periods. But now banks prioritize lending to wealthier clients or true first-time buyers with strong financial profiles. Borrowers trying to refinance simply to survive are often rejected outright. And when refinancing disappears as an option, desperation replaces patience. But there's another category even more fragile: the outer edge communities surrounding major cities. These districts attracted buyers who couldn't afford central locations during the market boom. Agents convinced them distance didn't matter because cheap loans made monthly payments manageable. At the time, paying under $20,000 per month for ownership sounded far better than renting. But today, many residents face a painful reality. Living far from city centers comes with hidden costs: longer commutes, higher transportation expenses, increased daily stress. As inflation pushes up fuel, food, and living costs, families discover their budgets are collapsing. And when mortgage payments suddenly jump from $18,000 to over $30,000, the financial strain becomes unbearable. These outer districts usually suffer first when markets weaken, because demand there is always the most fragile. When even a few foreclosure or auction properties appear at steep discounts, buyers quickly adjust expectations. And once discounted sales establish new price levels, support for previous valuations disappears almost instantly. So if someone tells you infrastructure improvements are coming soon, and this is your last chance to buy cheaply, take a deep breath. Because transportation lines may arrive in the future, but your cash flow problems could arrive much sooner. At this point, many viewers are probably asking the big question: does this mean ordinary families should completely give up on buying homes? Not necessarily, but timing and strategy matter more now than ever. Before we discuss survival strategies, Let's connect the full logic chain explaining why entering the market today could still mean catching a falling knife. First, supply is exploding. Projects launched during the boom years are now being completed simultaneously. Large volumes of new homes are entering the market all at once. Second, demand is shrinking. Higher interest rates and stricter lending standards mean fewer people qualify for loans. Buyers have become cautious. Third, property markets don't crash instantly like stocks. Real estate declines slowly. Transaction volumes freeze first. Prices remain stubborn for months. Only later do sellers begin lowering expectations. And right now, we are in that transition phase, where transaction volumes are already weak, but prices have only just begun to soften. Many distressed owners are only now listing their properties. At this stage, asking prices still reflect old expectations and hope for profits. But as financial pressure intensifies and banks begin foreclosure procedures, panic selling eventually follows. And that's when genuine distress pricing appears. To put numbers into perspective, consider this. A borrower paying under $15,000 monthly during the grace period may suddenly face payments exceeding $33,000 once principal repayment begins. That extra $20,000 per month used to pay for children's education, household expenses, or emergency savings. Losing that financial cushion crushes many families, which is why stepping into the market right now to rescue someone else's bad investment with your life savings could be a costly mistake. But then comes the critical question. If families genuinely need homes, how can they protect themselves in this environment? That's exactly what we'll break down next. So now we arrive at the most important part of this discussion. If you are not a speculator, but a real family looking for a place to live, how do you survive a market like this without becoming the next forced seller? Let me give you 3 survival rules that matter more than ever in today's housing environment. The first rule is simple. Cash is safety. In uncertain markets, liquidity is more important than ownership. If you already saved enough for a down payment, do not rush to throw every dollar into a property purchase right now. Banks are extremely cautious with appraisals, and even if you find what seems like a cheap property, the bank might value it lower than the transaction price. That means you must pay the difference out of pocket. And if you emptied all your savings just to secure the down payment, you'll suddenly find yourself with no buffer. Always keep at least 10% of your funds untouched as emergency reserves. Because when true distress opportunities appear, foreclosures, urgent sales, undervalued assets, only buyers with cash flexibility can act quickly. The second rule is avoid communities dominated by investors. If more than 30% of owners in a neighborhood are investors instead of residents, you're buying into a ticking time bomb. You can observe this in simple ways. Visit the area at night. Check how many apartments actually have lights on. Look at rental listings flooding the same community. When financial stress hits investor-heavy buildings, owners compete to sell quickly, driving prices down for everyone. At that point, even financially stable homeowners watch their property values collapse because of neighbors who cannot hold on. Today, the financial stability of your neighbors matters more than fancy interiors or luxury amenities. The third rule is strict income discipline. Many buyers convince themselves that ultra-long mortgages made higher payments acceptable. Some families now commit half of their monthly income to housing loans, believing future salary growth will solve the problem. But in uncertain economic conditions, that's extremely dangerous. Your mortgage payment after the grace period must never exceed 35% of household income. If calculations show you exceeding that threshold, you must walk away, no matter how attractive the property looks. Because life is unpredictable. Job loss, health emergencies, economic downturns. Any unexpected event can push a stretched household into crisis. And once payments stop, the bank will not wait. And that's how ordinary families become forced sellers. When we look back, the housing program that once sounded like a shortcut to happiness now feels more like a harsh financial experiment. Young buyers, eager to secure homes, were pushed closer to financial limits than they realized. Policies may have been created with good intentions, helping people get onto the property ladder. But nobody warned buyers what happens if that ladder leads toward a cliff. Climbing faster only makes the fall harder. People often ask me, does this mean our generation will never afford homes? And my answer is this: a home is supposed to improve your life, not consume it. If owning property means working endless overtime, postponing having children, canceling vacations, and living in constant financial fear just to meet mortgage payments. Then that house isn't a home. It's a debt prison. Property prices can fall and recover over time, but lost youth, broken families, and years of financial stress can never be reclaimed. Ironically, this wave of distress selling might ultimately be healthy for the market. It forces speculation to unwind and allows prices to reconnect with reality. And for patient, financially prepared buyers, opportunities will eventually appear. Homes priced within reasonable budgets, purchased for living rather than gambling. A true home should be a shelter from storms, not the storm itself. So instead of rushing to catch falling prices, focus on strengthening your financial foundation. Build savings. Maintain flexibility. Prepare for the moment when markets stabilize and genuine value appears. Because when the tide finally retreats and speculation disappears, the homes left at sustainable prices will be the ones truly worthy of being called home. Thank you for staying with me through this entire analysis. If this discussion helped you see the housing market more clearly, leave a like and share your thoughts in the comments. Are you seeing price cuts in your area? Are you worried about buying now? Let's talk about it below. And if you want more in-depth market insights to protect your financial future, make sure to follow the channel and share this video with anyone considering buying property right now. I'll see you in the next video.